welcome to our interview series where we bring you valuable insights from top fund managers across leading AMCs. Now, joining me and my colleague Chirag today is Shridatta Bhandwaldar. He's head of equities at Canara Robeco Mutual Fund. Welcome, Shridatta.
Thank you. Thanks, Ruchira and Chirag, for having us on the interaction. Thank you.
Good to have you back with us. Now, to begin with, can you tell us, with the increased volatility in equity markets, do you expect it to subside, or is this level of volatility likely to continue in the near future? What's your take on that?
First, you have to assess as to why the volatility has increased. Okay, and when you step back and think about it, there are two or three reasons because of which the volatility has gone up. Uh, of course, there was a context which was setting up for it because the domestic liquidity and domestic valuations were moving higher. Uh, but the reason why it has translated into volatility is clearly that the corporate earnings growth have been subdued. The growth has getting downgraded, not only at GDP level, but even at a corporate earnings growth level. And I think that's a predominant reason uh, for which the context was set when the domestic investors were putting in liquidity at a valuation which was clearly unsustainable and which we have through various forums have actually alluded to. So that was one reason. It was, of course, uh, and it has coincided clearly with what is happening globally. Globally, there is a realignment in terms of the thought process, particularly from a unipolar world where US uh, was wanting to deal with everybody to now not wanting to deal with anybody, or actually, in a simplified terms, put tariffs on others, probably have lower corporate tax rates in US, and actually shift back some of the manufacturing or activities to their homeland rather than procuring it from globally. And what it means is the earnings growth there, or the growth there, hope about it has increased, that probably the growth rates in US, earnings growth in US would be superior. Now you have a mother currency where you are not taking any risk. The growth prospects are improving. The valuations X of tech companies is okay. And the new leader is saying that, okay, we will do everything at home. Whether it will happen or not, only time will tell it, and most likely it will not happen. But at least there is a noise. And when you have this combination, naturally the FIs decided to pull back money from all the emerging markets, and we were just one of them. Of course, our higher valuations did not help in this context, and that's where last 1 month you have seen probably 60, 70, or 80,000 crore rupees of outflow just in single month. So I think predominantly these two reasons. One, our own domestic setup, which was there for last 1 year, or particularly 6 months, where the earnings were or growth was slowing, but the people continued to actually uh, keep allocating money at higher and higher valuation, particularly to the broader market. And second, globally, what has happened in this ramification for both growth as well as particularly capital flows. I think those are the two predominant reasons because of which we have witnessed the volatility. When you actually look forward, uh, and you can only guess, make a hunch, and we can be right or wrong. But the guess, at least from my side, is probably you've seen the worst of the volatility, particularly the so both the things. Now let us take one by one them again. Domestically, the earnings expectations are getting reset in terms of where people are expecting financial year 26-27 earnings growth. Financial year 25 will be single digit earnings growth. Financial year 26-27 now is penciling in anywhere between 11 to 13, 14% earnings growth, depending on the index that you are looking at. So clearly, earnings reset of expectations has happened. Point to point, if we exclude last 2 days, small cap index is down 20%, mid cap is down 16%, and large cap index is down anywhere between 12 to 13%, depending on which large cap index you are using. So clearly, from that perspective, the froth is also out. I'm not saying the valuations have corrected to extremely attractive level, but the froth is out. Uh, and on top of that, I think large caps are at a valuation where they have been historically. So there is no froth in large caps. Anyways, it was relatively limited because the FIs were sellers. So it was fairly efficient market in terms of price discovery. So you have large caps trading at roughly 19 times, which is barely expensive than its own last 10 years historical valuations. Uh, as you go to mid cap, small cap, while the froth is out, still they are expensive in the context of the way earnings is playing out. So, but nonetheless, this first factor, the froth is out. The expectations have been reset, so volatility should actually subside unless until we see something incrementally happening. That's on this side. Second, it's always basically you buy on news. rumor and sell on actually fructification of event. And that's what is likely to happen as far as the global environment is concerned. My sense is, irrespective of how much noise the new administration is making in US, they'll only be able to do 10-20% of what they are saying, because suddenly you can't actually change the economic and cost structures of countries. You can't change the skill set structure of the demographics. So you can't suddenly do things which are actually being quoted. So people are bound to get disappointed who have gone back there in the hope that in certain segments the valuation, basically the growth rates will substantially increase. So uh, on that side also, I think that uh, on one side the froth is getting reduced, on the other side froth has already happened, so it is bound to get reduced, and as it gets reduced you will have basically capital flows at least subsiding in terms of outflow. I don't know whether they'll come back immediately or not, because that will be a function of how attractive and how our earnings growth plays out. But at least the capital flows at some point in time over next 2 quarters, you should start seeing reversing towards emerging market. Now, which emerging market receives is a function of how we do in that context. So I think that's where my take from next 3 months perspective is gradually, 3 6 months perspective is gradually. On one side reset of expectation has happened, on the other side the worst of the froth you are seeing, a reduction of which should help us in terms of flows. So you're seeing probably the worst of the volatility, and it will gradually subside, and can become little painful if the earnings growth don't show up next quarter as well. So I think that's how we are looking at it. But clearly, within large cap, I think the valuations have corrected to a level where there is no froth left in that part of the market, clearly.
Sir, as you clearly mentioned, the froth has been cleared to some extent, and earnings growth are likely to improve in the next few quarters. Apart from these two factors, what other factors are the trigger which will drive the Indian economy going forward?
No, so now again, let us step back and think about it. What could be the drivers apart from earnings growth and FII flows at the margin, probably not being negative or being positive? I think clearly the monetary lever could not be used because you had growth slowdown, you had taxation slowdown. So fisc, probably government can't use fisc beyond a point, and at the same time you had external environment which was adverse, so currency was under pressure, so you can't use the monetary lever. Otherwise, if you think in isolation, the domestic inflation or particularly core inflation and WPI should allow you to reduce the interest rates by anywhere between 25 to 50 or 75 basis point over next 6 months. But that lever has been not used. So that's the, I think, lowest hanging fruit as I see it, that as the currency pressure abates, globally for all emerging markets and particularly for India, your interest rates as a tool can come to fore over next 3 months. So that's one easy tool that is available. Second is like what RBI did. It started with OMO. Uh, we are expecting, and this is just a hunch, that probably the administrative tightening of the entire banking sector, entire NBFC space, which unfortunately happened during a phase where liquidity was also tight and where there was no other credit flow, and FIs also started selling. So all forms of liquidity tightening, actually, consumer ended up experiencing, and it showed up in particularly microfinance and some of the unsecured categories. Our sense is that is the second low hanging fruit, whereby just providing liquidity support to certain parts of the economy will lead to basically earnings being better than where they were in, or growth being better in that part of the market. Third is clearly the rural part. I think you've seen the worst of that in a perverse way. When any policy making turns extremely on one side, uh, there is a economics, there is a politics which brings it back to the center and then to the left. I think we have started coming back to center, where in terms of policy making, where ignoring the rural or poor masses is no more a possibility. And that's where gradually the spending is shifting only from capital expenditure or capex towards some of the social infrastructure, some of the freebies. While we don't like it, a lot of people need it in the economy, and that amount is roughly about 2.5 to 3 lakh crore rupees of annual spending by state governments. So we clearly have a division whereby central government will continue to pursue a steady fiscal control, whereas all the little bit of a center or center to left policies will be run, which are needed at the for the last 50 crore people in this country, probably would be run at the state level, and that does benefit the mass consumption part, liquidity part, low ticket consumer durable part. So that should also help growth in certain parts of the market. So those are two or three, I think, low hanging things that you can clearly think of, whereby your growth will bottom and start reversing. Are we expecting suddenly financial year 26 to be a 7.5% GDP or a 20% earnings growth year? No, I don't think that's a possibility, or very high possibility in the environment where central government is clearly constrained for resources incrementally, given where they are headed, and private capex is growing at 8-10%, but still not actually picking up beyond that. Um and liquidity was tight. So when you combine all these things, my sense is, while directionally the public capex will translate into private capex and real estate and consumption, it is happening at a much slower pace than what one would, or what even government would like for private sector to do, for various reasons, and probably predominantly is a demand from consumer side. So I think those are two or three easy levers: monetary lever, the administrative and liquidity lever at the end of RBI. Third is the mass consumption and support to it from central stock center, more of state governments. Those are, I think, easy levers available.
Now, you did mention high valuation. So, given the current market correction, do you believe valuations have become more attractive now?
Of course, they have become attractive than where they were 3 months back, but on an absolute basis, and more than absolute basis, in the context of incremental earnings growth that is penciled in today, I think large caps are at fair valuation. Clearly, they have come back to their 10-year averages, and their earnings growth is likely to be 10, 12, 13% CAGR, which is the consensus for next 2 years. And I'm skipping 25, 26, and 27 is what I'm counting in. Uh, but as you go into mid cap, small cap, um I think still the valuations are at least uh, uh, 10-15% higher, or 20% higher in certain pockets, than where they were historically. Uh, our take still is, they will still keep correcting, but you might not get a knee jerk or a volatility, downside volatility, like you saw in one shot, whereby you had 1.5-2 months where index just corrected 15-20% in the broader market. I guess it will be more now combination of people who want to incrementally see whether that part of the market surprises in terms of earnings. If it doesn't surprise, gradually it will be more time correction which adjusts the valuation rather than price correction. That's how we are looking at it incrementally. I think the froth has been taken out. The weekends have been taken out clearly. The lot of retail leverage part has been taken out from market. People who are just buying because somebody else is buying, I think a lot of that is taken out in this rally, because while it looks like the small cap, mid cap indices have corrected by 15-17%, um, on absolute basis, some of the aggressive portfolios are corrected by 30%, and some of the individual stocks are corrected by 50%, and there is no sign of them returning immediately, because the earnings are also not coming in. So to that extent, that part of the market, one has to still take a, there's nothing wrong investing in that part of the market through SIPs, but one should take a little longer view, one, and still one should be careful about the kind of portfolios they are choosing. Last 2 years, it didn't matter what kind of portfolio you chose. Probably the riskier the portfolio you chose, the better were the returns, in our humble assessment. But here on, when the normalization of economy will happen, the boys will be separated from the basically main. The main will be separated from the boys, and you need to be in portfolios where, even in small cap, mid cap, you're associated more with main than the boys. So I think that should be investors' focus incrementally, if they want to go in that part of the market.
Sir, now coming to your investment philosophy, could you broadly explain your investment philosophy and how it has been evolved over the years?
Our investment philosophy, like last time also we discussed, has been
Yeah.
very simple. That at core is business. If the business has some form of advantage over the rest of the businesses in either in that sector or overall market, if it has a scalability, in terms of, which means opportunity set to grow for multi-year, and if it has capital efficiency, which means at least it is covering for its cost of capital, which means at least 15-17% ROE, ROCs, because in India cost of capital is 11-12%. And then if you have a guy, or a person who's running it, who understands uh, and cares about capital efficiency, those are the businesses which is our first preference. Of course, we are public money managers, so we can't be purists. But anything, uh, if I combine all these things, anything that actually satisfy or comes in top two quartiles in terms of basically what kind of business you are dealing with, what kind of management you are dealing with, and what kind of balance sheet you are dealing with. And on top of that, is there a scalability and long runway for those businesses? That typically, or at least 3-year runway, those are the businesses which typically we want to basically hunt for. That's our core philosophy, that focus on businesses. Don't focus so much on stocks or market, what is happening, because stock prices in short term don't tell you anything about what is happening in the business, and which you have experienced just now. Just look at last 1.5 year. Certain stocks went up 100 200% and they came down 50%, which means they are where they were 2 years back. So and that happened because probably underlying business doesn't support it. So that's the core philosophy, and with that philosophy we have actually constructed an objective that, given that it is a relatively growth market, uh, we would want to invest in businesses which are growth oriented, which are run by competent management, and at a reasonable valuation. Reasonable valuation is always intrinsic valuation for businesses which have a long runway. A business which has a long runway, scalability and capital efficiency will never come at 10 p generally. I mean, once in a while it will happen, but rarely it will happen. But so that's always our first preference. But of course, we are a blend with a uh, tilt towards quality. Value proportion generally in our portfolios is 20-30%, not more than that. So our first preference always is, if I get a quality growth management business in traditional definition term, then I would seek for incremental capital efficiency and incremental earnings growth, and wherever it is, we will go there. Uh, of course, there is 20-30% of the portfolio where we also call them alpha generators, where you would want to go because there is something that is changing in the sector. Say competitive intensity is going down, so capital efficiency improves, growth improves for the survivors. Turnaround is happening in sectors. Operating financial leverage is incoming in certain sectors. While they might not be basically structural stories, but from a 2-3 year perspective, they can generate a lot of alpha because you will get earnings re-rating and basically multiple re-rating than that phase. So that's value in our view, that any business where there is a intrinsic time bound or discernible driver in place, and we if we can pencil in that for next 2 years these are things which are most likely, and you can get re-rating and earnings growth, then that part of the value we play. So that's the combination we play, but typically the first preference is towards quality businesses management, as long as we are not overpaying for them, and then look for value wherever uh, the value is more likely to get delivered rather than remaining value trap for a longer period. So I think that's core to our thought process. Beyond that, it is all um, basically bottom up. So while we understand top down, we use far more bottom up uh, to understand that analytically uh, you can make money and you can beat the averages only if your assessment of incremental earnings growth and incremental capital efficiency is better than the averages over a period of time at portfolio level, not in one company to company. And if we can, and that's where the day-to-day focus is in terms of research, that any discussion should end in terms of making assumptions, converting those assumptions into actual numbers, and seeing whether those numbers are ahead of consensus, behind consensus, and more than numbers, on what assumption basis it is happening, because that allows you to actually over a period of time uh, kind of attempt superior outcomes. And that's what the I think the regular attempt is over and above the basic investment philosophy.
Sir, in our earlier conversation, you had mentioned that the dominance of value investing since 2021 has posed some challenges to the, as you rightly mentioned, the growth and the quality focused fund. How is it playing it now?
So frankly, at a very fundamental, we use growth, quality, value, because all of you guys and the audience and readers understand it that way. Fundamentally, in our mind, it is like this: there are businesses which are deep cyclical, and there are businesses which are narrow cyclical. Typically, we prefer narrow cyclical businesses because they save you in bad times, and they have structural characteristics in terms of ROE, ROC, and other factors. So they give you long runway. And clearly when cyclically uh, you get economic upturns like what you saw in calendar year 21-22, you get a lot of basically cyclical businesses doing far better than those narrow cyclicals, which is what people typically tend to call as growth quality. Okay. uh, and when those narrow cyclicals do well, of course we suffer because there are a lot of commodity energy companies, converters, where inherently the capital efficiency or ROE ROCs through cycle are very weak, but in that particular 1 or 2 year period they end up doing well. And ultimately our learning, like you asked learning also, the learning is that irrespective of the long term prospects and your assessment about long term aspects, a lot of time the near term, and near term means 1 year 2 year earnings deviations also end up actually creating outperformance in far weaker franchises as compared to relatively superior franchises, which is what people calling as value doing well, for example. And why did it do well? It didn't decide one fine day that, oh, all of value stocks or cheaper stocks should do well. They did well because their earnings growth was superior to a lot of growth quality names in that particular period. And it was well because the entire cycle actually had gone to toss in calendar year 20, right from 17 to 20 for a lot of these businesses, and it came back. As it came back, naturally their earnings growth was superior to a lot of the compounding businesses. Not as if compounding businesses were doing badly, but it is just that they were fairly priced and they were still delivering 15% earnings growth. Whereas somebody whose earnings became one third, actually earnings became three times in 2 years. So naturally, market ended up rewarding that part of the market. I think the normalization of cycle has again happened, like what I said, and last 6 months is already visible, is visible to us also in our portfolios, and we were always confident that it will happen. That we don't want to go in lot of businesses where we know that our conviction uh, will not allow us to stay even for 6 months or a year. Uh, that's not the kind of businesses we want to own. Yes, there will be intermittent pain, and you have to take that pain time to time. But once you take that pain, uh, the compounding again starts, and which is what you are seeing in a lot of these businesses, that the compounding is continuing, whereas the cyclical part of the businesses, or a lot of value part of the businesses, are clearly in terms of incremental earnings growth have plateaued and they are not growing anymore. And just hypothetically, and I'm taking actually a live case. Okay, one of the company, a large company whose earnings actually tripled in last 3 years, now has a 0% earnings growth over next 3 years, and it's a value stock. Okay, so the same thing is happening to them now, that there is no incremental earnings growth. They have re-rated, whereas the other part of the market, which is typically people tend to call as growth quality in a very loose term, continue to grow at, a lot of them continue to grow at 15%. So now they will get rewarded, that part of the market. And I think that's just a cycle from a top down perspective. Yes, for us our learning is that as a public money manager, if there is a part of market which is uh, acceptable, and even if it is deep cyclical, if the earnings are turning, it makes sense to be basically humble and respect that, and have that as some part of portfolio, if not a lot of it, because you don't necessarily have the underlying fundamentals in those businesses to have a lot of weight in those businesses. So I think that's how I would see. And clearly we are seeing that basically that blend or tilt towards basically relatively better businesses, rather than saying growth quality. I would say from a hygiene perspective or from a fundamental perspective, the businesses where the management's balance sheets and the promoters are good, they are coming back, and it is very very visible. And as the environment becomes more and more normalized, they'll keep coming back more and more in our view.
Right now, moving on to some fund-specific questions. So, Canara Robeco Blue Chip Fund and the Focused Fund, they've done well in 2024 after some rough patches in the previous 2 to 3 years. So, what really has worked for these funds, if you could share with us?
If I can add basically Canada Robeco Emerging also to that, that has also done extremely well over last 1 year. I think what has worked is when we stepped back and said, okay, what is not working in calendar year 23, and we clearly realized that we have particular strength, and everybody has to play to their strength. It's just like game. If it's a game, you play to your strength, the chances of winning are higher. If you try to actually play to somebody else's strength, the chances of winning are very very low. What we realized is that because the market was so basically tilted towards uh, uh, in a loose term, again non value side part of the market, you had very very limited pockets where you could actually play, uh, and we were actually diversifying a little more than what was required, because assuming that in market there are only 100 stocks, there was a period between 17 to 21 where you could play 50-60 stocks, because that was your playing area. In calendar year 23 and part of calendar year 24, it became slowly 25 stocks. 75 stocks were something that you didn't want to play fundamentally, because you know that there is either a management challenge, there is no structural story, it's just cyclical, deep cyclicals, for whatever reason. and that's for us, not for everybody. So and we were diversifying, which means we're putting in little less weights in a lot of spaces where we had conviction. What we realized is that if you have playground which is relatively smaller, we need to concentrate a little more than what we were doing in the earlier cycles. Because your playground was relatively smaller, and that playground will expand now, so we didn't need to probably do it anymore in calendar year 25 and 26, in my view, because that part of the market will become from 30 to 50 now probably. And that's exactly what we did, whether it is focused, blue chip, emerging. Actually, we sharpened some of the names that we were anyways owning, and we got rid of some of the growth quality names which were not delivering earnings growth in relative context. And I'm just giving for a hypothetical example purpose, and this is just for explanation purpose, not a recommendation to buy or sell. Suppose we had both Avenue and Trend. uh, the only way for people uh, who can't buy, say, a 10% coal India in that period or 5% coal India in that period, we needed to have weight more in Trend rather than having it in Avenue, because Avenue was delivering 15% earnings growth, was already priced for that. Uh, Trend was delivering 50% earnings growth, was perfectly fitting our criteria, and was getting re-rated. Uh, till calendar year 23, we did that mistake, that we were actually a little more or a little less sharpened in terms of within our growth quality basket how we were positioned. As we actually sharpened it and actually said, okay, this is come back to basics. These are the places where there is no earnings growth. Even if we like them as businesses and managements, the incremental earnings growth for next 2 years is not probably as much as you want, or as much as generally is there in market. Let us move to the part of out of that 30 percent of the market where we like the businesses, we like the management, and the earnings growth is superior to markets, and that's where we sharpen. And those are some of the things. And I think this is one fundamental thing which we change in some of the portfolios. And actually, the portfolios where we actually quickly change this, those are the portfolios which came back actually within the next 6-8 months. So it's just learning, and we keep learning, and we make a lot of mistakes. Actually, frankly, all 10 years I've been managing money, and we have made enough number of mistakes. So as long as you don't make a mistake which creates huge drawdowns, I think that's fine. So we did learn out of that we need to sharpen our position within the relatively compounding quality growth businesses. So we did that, and I think that's what shows up in consumer discretionary, auto, industrials. We sharpen our position, retail significantly in across these portfolios, rather than holding 1.5%, which is typically our actually thought process. We like diversified portfolios. We don't like concentrated portfolios, because concentrated portfolios have their own actually shortcomings as a public money manager, but and on size. Uh, but we did sharpen, and of course we did not concentrate it. We just sharpened it. That if you were holding 2%, we moved it to 3.5%, rather than actually moving it to 10% or 5-7%. That's not our. We don't agree with that kind of thought process. So we actually just sharpen the position, get rid of your losers within the same basket, actually move that way to the winners within that same bucket, and that actually did help in recouping the performance. Of course, the other thing also is helping incrementally is, and I have said this in obtain number of basically conversation, that any portfolio attribution is a function of the market strategy. What kind of strategy is working in market itself, which means what is the color of earnings growth or growth at that point in time. Second is allocation, and third is selection. Okay. Strategy we can't do much about. We can't take a u-turn and say tomorrow we want to buy all 10p stock and become value investors or contra investors. That's not our strength area. So that is one thing you cannot change. uh, it is market context, it will change itself, and when it changes itself, you will benefit. Allocation and selection is in your hand. We always focus on that, and selection is the most sustainable alpha in our view. If you get your selection right, you always get your outcomes right. Okay. And portfolio managers are paid for selection, they're not paid for actually strategy or allocation, because they have their own shortcomings. Thankfully for us, while the selection we put in place incrementally sharpened it, the allocation was anyways not bad. uh, the strategy of market itself is changing towards basically not rewarding too weak promoters, too weak businesses gradually, which is what you have seen over last at least 6-8 months, whereby market has realized that, okay, if somebody can't sustain earnings and I have given too much of valuation to it in calendar year 24, it has to be taken back, and which is what is the process is. And thankfully will not be there, because that's not our thought process anyway. So that reversal in the other part of the market is also of course helping. So it's not all basically our skill set. It is also basically that the market is reversing to some degree on the other part of the market, weaker part of the PSUs, weaker part of the NBFCs, weaker part of the small cap, mid cap category. A lot of PSUs, large, even larger PSUs, where only we were scratching our head why they are trading at the valuation they are trading. So
Sir, coming to the multi-cap funds, how do you manage this fund? And if you look at the multi-cap, you invest in the large cap, small cap, and the mid-cap segment of the market. Do you think that after the recent correction in the small and mid-cap segment, it has turned attractive, and you will be looking at these segments more, more keenly?
sure. So I think multi-cap as a category, I put it in a probably basically simple words, that anybody who doesn't want to bother too much with where my allocations are going, what is happening, and has a longer horizon, because effectively these are mid cap, small cap oriented products. Because if I have to keep 25% mid cap and 25% small cap, effectively I have to, at all point in time, I have to keep at least 54-55% mid cap, small cap, and 3-4% cash. So I'm actually more of a aggressive fund than a very very conservative fund. But at the same time, for an investor who's relatively young and who can take a little more risk and has a horizon, it's an extremely good product because it solves all problem. I don't need to then think about how much is my allocation in small cap, how much is in large cap, how much is in basically mid cap, because the mandate is only to keep minimum 25-25. If suppose in next 1 year mid cap, small cap corrects another 20%, I can go to basically 75% mid cap and small cap in this product. So that way it's an automatic allocation, single product which solve all the problem for most of the investors. uh, but even from today, like what I said for the broader market earlier, I think this is a product more suitable for people who at least have 3 year view from here. Anybody who has a 1 year view, 1.5 year view, I think they'll be better off in blue chip, which is large cap, or flexi, or a focus, which are large cap, or consumption fund, which is again aggressive hybrid. Uh, Anybody who want to take a little bit of a beta and want to generate higher returns over a period of time, but at the same time is willing to take some more volatility or some more underperformances, in our view, they should be the ones who should looking at multi-cap. But it's a beautiful solution for somebody who doesn't want to kind of spend too much of time on things and say, okay, I want to allocate and I want to allocate in single product, just allocate to multi-cap and forget about it. The fund manager will take care of the rest of the things. And also, the most important is also takes care that the fund manager also doesn't become too conservative. So the investor has already taken a call that I want 50% mid cap, small cap. Uh, so unlike flexi, where while there is a flexibility, typically we run it 70-30. In multi, the investor or the mandate itself has ensured that's at core it is a relatively aggressive product. So it should be bought with the volatility and long-term returns in mind, rather than really any short-term view. I think it's coming. That product probably for next 3-6 months will become again attractive from incremental investment perspective.
Coming to your FlexiCap fund now, which is, it has underperformed the benchmark for 1, 3, and 5 years. So what do you think are the key reasons for this underperformance, and how do you plan to improve it?
I think 3 and 5 year, 1 year it has started outperforming. Okay,
Okay.
thankfully. The one thing that and this is true when you are outperforming, and this is true when you are underperforming, because we run various funds, and I run focus and blue chip also, and I run flexi also directly as a day-to-day fund manager or a lead fund manager. So the one thing that we did not, because timing can always be a very very tricky thing when the market has moved like that and we're against the market, and now you're trying to change the portfolio. In flexi, we did not sharpen the portfolio enough in our view, which we started little late in last 3-4 months, and it's actually already started showing the outcomes. But we kept it diversified, and that did not help. So it had winners and it had losers, and they were canceling each other fundamentally. But if you look at 3 year, and which is what typically we tend to look at, what has hurt us is this entire uh, value rally in PSUs and small cap mid cap allocation. Like what I said in just previous question, we have never run flexi with 50-50 mid cap, small cap. That category is a very very heterogeneous category. So while everybody says that it is a flexi strategy, okay, there are people who have fund which are below 5,000 crore, they are with 50% mid cap, small cap. There are funds who have 30%, 40% global technology companies. So very very diverse category. And then there are rest of them which are upwards of 10,000 crore AUM, and most of them are sitting at large cap orientation. And within large cap orientation, we had growth quality tilt, and of course it did not help. So PSUs and under allocation in small cap, mid cap did end up hurting the portfolio from a next. This is a very, very simplified explanation of at a very broad level. Of course, there would be a set of mistakes that we would have done in terms of selection and not sharpening it a year back, which we started doing with some of the other categories. I think that that did hurt us, but it's always, I mean, everything is learning, and we learn and then move on. So that process is already started in that portfolio also, and my hope is over next 6 months that will again see the same sharpness in terms of selection within our area of competence, and that always helps logically. It is just that when you do it and how fast you do it, and sometimes whether you should do it or not, if you have lost the opportunity, that becomes very critical. So I think that's the broader answer to your question, that this entire PSU value part of the portfolio was lower, and mid cap small cap allocation against category, I think we are 10% lower. So 10% lower with probably 25% return differential is 250 basis point of hurt on that allocation itself. So that's combination of those two things which has hurt us. But still we have retained that thought process that Flexi is as a product, and even before recategorization, has been sold as a relatively conservative product. It has not been sold as a multi-cap or a large plus mid category or a mid-cap small cap. So uh, why should I offer risk in that portfolio? If I have to offer risk or beta or a higher mid cap, small cap, I have products which is large plus mid. I have product which is multi cap. I have product which is small cap. I have product which is manufacturing. I have product which is mid cap. So there are enough products for investors to choose if they want to actually go up the risk curve and volatility curve with a return expectation over 3-5 years. Should I change the basically the core of how we have run it? We don't think that we plan to do that. We last 9 years I've been running this product. Out of those 9 years, 6 years it has outperformed the benchmarks and peers, or 5 years at least. And at that point in time, also we said the same thing. Today also we are saying the same thing, that it is a product for relatively uh, conservative investor who want something which is large cap plus, uh, not a mid cap small cap product. So we will continue to run it 75-25 or 70-30. That's the band, and we'll continue to run it that way. And that hurts during the phases when mid caps or bullish phase comes in market against some of the peers, of course.
So, coming to the small cap fund, which has struggled in the bottom quartile for 2 years, despite a strong 5-year record. So, what key factors led to this, and when do you actually anticipate a turnaround here?
I think there clearly, I mean, what has not worked for us is, I mean, and here I'll go into basically allocation and selection more. I think some of the allocations which were made to building materials, chemicals, really struggled in calendar year 23 and part of calendar year 24. So that was one thing which clearly hurt. Second is also, we took probably a call on mid cap, small cap IT too early as a house. It has hurt us actually, IT as a sector. Till 6 months back, it hurt us across the board because we were present in the mid cap, small cap IT, and at some point in time in calendar year 22-23, we said, okay, their valuations have just gone through the roof. Last 20 years, they have never traded at a premium to a large cap for such a long period. They always do it for 3 months, 6 months, and then they go back. So we decided to actually trim some of those IT exposures. And in small cap, of course, they did disproportionately well. So not only sector was underweight, it was also basically the IT selection, which was a little more mid cap, large cap oriented in that portfolio also as compared to small cap. So those are the allocation selection mistakes which hurt the most in that portfolio clearly. Otherwise, when I look at the top 10 holdings, when I look at the sectoral positions, clearly we captured the entire EMS rally, we captured the entire defense rally, we captured the entire domestic pharma rally, we captured the entire industrials rally, we captured the entire capital markets play rally in that portfolio. But of course, we also had losers in the form of basically not participating in IT or selling it early, and actually having some of the exposure, probably 5, 7, 8% exposure to chemicals plus buildings material, which really underperform in that phase. Again, a 12-13,000 crore small cap portfolio, I would always recommend that look at least on 5-year basis. It continues to do well on 5-year basis. These portfolios actually, when you change, it takes almost 6-8 months to just change the positioning, and then 6-8 months, a year to actually seeing whether those outcomes or whether the theses that you put in played out or not. But I think that's how we are looking at that portfolio. It still continues to be one of the best performing funds since we are launched. So we are not worried about the near-term underperformances. Yes, as I said earlier, also what we always worry about is my selection ratio, hit ratio in stock selection improving or not, and that we keep reviewing every month when we sit for the portfolio reviews.
Sir, after the recent correction in the markets, which are the sectors which you think are, turning attractive, and which are the sectors which you think are still overpriced?
So I think, Chirag, at this point in time, market is at a very very interesting phase. Okay, whereas the sectors which are extremely attractive, the earnings growth is still very very low. For example, the entire consumption basket is very attractive, except some retail companies, but unfortunately, the earnings visibility is low. IT relatively, while it has done well, still attractive, but the incremental earnings growth upgrades are not happening. Everybody is bullish. US is likely to do well, but we are not seeing the upgrades as of now, barring probably a name or two. Uh, Cement is very attractive in my view. Has underperformed. Numbers have started turning around. That's one space where the numbers have gradually started turning around, and the valuation is attractive. Chemicals, again, the numbers have started turning around. The valuations is attractive from a medium term perspective, not in near term perspective. Large lenders, large NBFCs, I think extremely attractive. But in this space, again, while the NBFCs have very very good earnings growth, large lenders earnings growth for financial year 26 will still be high single digit or low double digit. So earnings growth is not really through the roof, or say 15-20% also. Which are the parts of the market where the earnings are very strong? Industrials, select auto, hospitals, hotels, telecom, pharma, aviation. The numbers continue to be fairly good. Within them, only industrials had become a little more exuberant, which I think has largely been course corrected in this rally, in this fall.
Okay, well, with that, it's time for us to wrap up this chat. Thank you, Shridatta, for taking time for this interaction. It was good speaking to you.
Thank you so much, Ruchira and Chirag. Thank you.